Hello and welcome back to the channel. I am Abhishek and I am thrilled to have you join me for another CFA Level 1 review lecture. Today's topic is Portfolio Risk and Return Part 2 for CFA Level 1 2025. I will be covering all the key concepts so that you can feel confident and prepared for your exam. If you find this video useful, please like it and subscribe the channel. And as always, drop any questions you have in the comment section below. Now let's jump right in. There are 9 learning outcome statements in this module. We'll go through them one by one. Describe the implications of combining a risk-free asset with a portfolio of risky assets and explain the capital allocation line and capital market line. So first of all, what is market? The market includes all the risky assets which include stocks, bonds, real estate and also the human capital. But for practical reasons, let's assume that a broad index such as S&P 500, it represents the market. First of all, what's a capital allocation line? A capital allocation line includes all possible combinations of the risk-free asset, and an investor's optimal risky portfolio. The risk-free asset is a debt security with no default risk, no inflation risk, no liquidity risk, no interest rate risk, and no risk of any other kind. Basically, an asset which is totally risk-free. Let's say for proxy, we can use T-bills as risk-free asset, and the shortest maturity government deposit is a proxy to the risk-free asset. So the capital allocation line defines that how much capital is allocated along with in these two assets, the risk-free asset and your market portfolio. That is your capital allocation line. Now, what is a capital market line? The capital market line is a special case of capital allocation line where the risky portfolio is the market portfolio. So this portfolio here, the optimal risky portfolio, in case of capital allocation line, this is the investor's optimal risky portfolio, and in case of capital market line, this is the market portfolio. The risk and return characteristics of the portfolio represented by the CML can be computed using risk and return expressions for two asset portfolio. Now let's say the expected risk of the portfolio, what it will be? It will be the weighted average of both the returns from both the assets. The first asset is the risk-free asset, the second one is the market portfolio. So the expected return of a portfolio which combines a risk-free asset with the market portfolio is the weighted average of the respective returns. And what should be the risk of the portfolio? The standard deviation. It's the square root of W1 square sigma F square 1 minus W1 square sigma M square. This is the market portfolio's deviation. This is the risk-free assets deviation. Plus 2 times W1 times 1 minus W1 times covariance between the risk-free asset and the market portfolio. The W1 is the proportion invested in the risk-free asset, and the balance 1 minus W1, it represents the portion invested in the market portfolio. Now we know that the standard deviation of the risk-free asset is 0 because its risk is 0. So and also the risk-free asset does not co-vary or move along with any other assets. So that means the covariance of risk-free asset with all other assets is also 0. So this term and this term, they both become 0 in this case, and we are left with sigma p equals to 1 minus W1 times the sigma m. That means the risk of the portfolio combining a risk-free asset and a market portfolio is reduced to the proportion invested in the market portfolio 1 minus W1 times the standard deviation of the market portfolio. So using this equation, we can rewrite the expected return of a portfolio like this. The expected return of a portfolio is equal to the risk-free return plus expected return on the market portfolio minus the risk-free return. This is the return to bear some risk divided by the standard deviation of market portfolio times the standard deviation of the resulting portfolio. Now let's talk about lending and the leveraged portfolios. This is your market portfolio and this is your risk-free rate, right? Now let's say if you invest 10% of your assets in the risk-free asset, let's say you invested 10% in this and 90% in the market portfolio, right? So in this case, you have lent 10% of your amount at a risk-free rate. This is your lending portfolio. It can be achieved by the points between these two limits. The investor is lending part of his or her wealth at the risk-free rate, right? So this is your lending portfolio. Now the points to the right of the market portfolio, that means on this line, these points are achievable by borrowing at the risk-free rate. So if an investor is willing to take more risk, he may be able to move to the right of the market portfolio by borrowing money and this represents the borrowing portfolios. Now with different lending and borrowing rates, CML will no longer be a straight line, because if you are lending money, you are lending it at the risk-free rate. But if you are borrowing money from some bank or any lender, that it could be the case that your borrowing cost will be greater than your risk-free rate. So in that case, your CML will no longer be a single straight line. The line will have a slope of this, the expected market return minus the risk-free rate divided by sigma m up to the point m. So this slope only works between RF and M, but will have a smaller slope of this at points to the right of M, where the borrowing rate is RB. So because of different rates, RF is different than RB, so the slopes of these two lines will be different. Explain systematic and non-systematic risk, including why an investor should not expect to receive additional return for bearing non-systematic risk. Now, what's the systematic risk? It's the risk that cannot be avoided and is inherent in the overall market. It is non-diversifiable because it includes the risk factors that are innate with the market and affect the market as whole. Now, what kind of factors are considered a part of systematic risk? Like the inflation, economic cycle, political uncertainty. These are the macro factors and these are considered as systematic risk. What is a non-systematic risk? It's the risk that is local or limited to a particular asset or a particular company or a particular industry, and it need not affect the assets outside of that asset class. What could be the example? The example could be a failure of a drug trial or an airliner crash. These events directly affect the respective companies or possible industries, but have no effect on assets that are far removed from these industries, which means if something is happening that is significant to the pharma industry, it may be the case that it doesn't impact the airlines industry or vice versa. So these are called the non-systematic risk. Now, being an investor, you can avoid a non-systematic risk through diversification by forming a portfolio of assets that are not highly correlated with one another. So, since you are able to avoid the non-systematic risk by diversifying, you are not awarded additional return for bearing a non-systematic risk. Now, what's the total variance of a portfolio? The total variance is equal to systematic variance plus the non-systematic variance. Explain return generating models and their uses. A return generating model estimates the expected return of a security given certain parameters. If systematic risk is the only relevant parameter for return, the model will estimate the expected return for any asset given the level of systematic risk. It means, since we are saying that non-systematic risk is not avoided, right? So that means the expected return on any asset should be governed by the level of systematic risk. As with any model, the quality of estimates of expected return will depend upon the quality of input estimates and the accuracy of the model. Now, since it's difficult to decide which factors are appropriate for generating returns, most general form of a return generating model is a multi-factor model. That means you use more than one factor to determine the expected return. It allows more than one variable to be considered in estimating returns and can be built using different kinds of factors such as macroeconomic factor, fundamental factors, statistical factors. A general return generating model is expressed in the following manner. The expected return on the asset minus the risk-free rate, that means the additional return that you generate on the asset, is equal to the expected return from different risk factors that you are bearing while investing in the asset. So beta in this case is the sensitivity of the asset to the risk factor, and this is the expected return on the risk factor. So market factor is always the one which will impact all the assets. So we have separated out the impact of market factor in this case, and all other factors are summed accordingly. Calculate and interpret beta. Beta is a measure of how sensitive an asset's return is to the market as a whole. That means if the market goes up, what will be the impact on your portfolio? This is a measure of beta. It's calculated as the covariance of the return on I and the return on market divided by the variance of the market return. The covariance of return on asset I, the covariance of return on asset I with the market return and divided by the variance of the market return. And this is equivalent to writing it as the correlation times the standard deviation of asset I divided by the standard deviation of market return. So basically the expected return of an asset is equal to the risk-free rate times beta times the excess return of the market. That means the expected market return minus the risk-free rate. So this is your expected return on an asset. It shows that the primary determinant of expected return for a security is its beta. The higher the beta of the asset, the higher its expected return will be. Assets with a beta greater than 1 have an expected return that is higher than the market return, whereas assets with a beta of less than 1 have an expected return that is less than the market return. So basically, if you have your beta greater than 1, your expected return on asset I will be greater than the expected return on the market portfolio. But if your beta is less than 1, then the expected return on asset I will be lesser than the expected return on the market portfolio. Explain the capital asset pricing model, including its assumptions and the security market line. Calculate and interpret the expected return of an asset using the CAPM. Describe and demonstrate applications of the CAPM and the securities market line. So these three learning outcome statements we'll consider them together. The CAPM is one of the most significant innovations in the portfolio theory. The model is simple and yet powerful. It provides a linear expected return beta relationship that precisely determines the expected return given the beta of an asset. It makes the transition from total risk to systematic risk the primary determinant of expected return. Because as we earlier said that the expected return is dependent upon the systematic risk and the non-systematic risk is not avoided. So the expected return on asset I is equal to the risk-free rate plus beta times the excess return of the market. The CAPM asserts that the expected return of asset vary only by their systematic risk as measured by beta. Two assets with the same beta will have the same expected return irrespective of the nature of those assets. So that's what CAPM implies. What are the assumptions of CAPM? It assumes that the investors are risk averse, utilizing, maximizing rational individuals. Markets are frictionless, so they include no transaction costs and no taxes. The CAPM doesn't consider any kind of transaction cost or taxes while generating the excess return, the expected return. It assumes that investors plan for the same single holding period. So CAPM model is a single period holding model. Investors have homogeneous expectations or beliefs. All investments are infinitely divisible and investors are price takers. So these are the assumptions of CAPM. Now let's talk about the security market line. Security market line is a graphical representation of the CAPM model with beta. It reflects the systematic risk on the x-axis, that is beta, and expected return on the y-axis, this. The slope of this line is the market risk premium, RM minus RF. This is your slope. What's the portfolio beta? Portfolio beta is a weighted sum of the betas of the component securities and is given by portfolio beta is equal to the weighted averages of the betas of individual assets. And the portfolio return is given by the expected return on portfolio is equal to the risk-free rate plus the beta of the portfolio times the excess return of market. Now, what are the limitations of CAPM? First of all, the theoretical limitations of the CAPM are that CAPM is a single factor model. It only considers the market factor as the return determining factor. Second limitation is it's a single period model. You cannot use CAPM for a multi-period holding return. The practical limitations of the CAPM are the market portfolio. A true market portfolio, according to the CAPM, includes all assets, which means that it also includes many assets that are not investable, such as human capital and assets in closed economies. So the market portfolio which is considered in CAPM is not investable and replicable. So this is a first limitation. The second one is proxy for a market portfolio. It is very difficult to determine the right proxy to be used for the market portfolio. So this is the second limitation. The third one is CAPM is an ex-ante model, yet it is usually applied using ex-post data. That means ex-ante model means CAPM is used to find the future expected returns. CAPM is used to find future expected returns, but we usually use the ex post data. The returns or the sensitivity of the assets is determined using ex post data to find a return that is in the future. So it is a limitation of the model. CAPM is a poor predictor of returns. If the CAPM is a good model, its estimate of asset returns should be closely associated with the realized returns. But the empirical support for the CAPM is weak. So that means the returns that the CAPM expects to generate are not exactly the returns that are realized over the same period. Homogeneity in investor expectations. The CAPM assumes that homogeneity exists in investor expectations for the model to generate a single optimal risky portfolio and a single security market line. Without this assumption, there will be numerous optimal risky portfolios and numerous security market lines, because one investor's expectations cannot be matched with another investor's expectations. They have different utilities and different optimal risky portfolios. Security characteristic line. The security characteristic line is specific for a security. It's a plot of the excess return of the security on the excess return of the market. Excess market return, excess security return, and its slope is given by the beta. So Jensen's alpha is the intercept. That means the alpha that the investor generates on the market return is the intercept, and beta is the slope. So the excess return on an asset is equal to alpha plus beta times the excess market return. Calculate and interpret the Sharpe ratio, Trainer ratio, M2 and Jensen's alpha. First of all, let's see what's performance evaluation. Performance evaluation refers to the measurement, attribution and appraisal of investment results. So there are three things. First one is portfolio measurement. Performance measurement. It is concerned with the measurement of portfolio risk and return. It answers the question, what was the portfolio's past performance and what can be expected in the future. That means your return and the risk assumed, which is denoted by the standard deviations. So basically you are calculating the returns and the standard deviations of a portfolio. So that is your performance measurement. Performance attribution is concerned with identifying and quantifying the sources of the portfolio risk and return. That means if a portfolio returned 10%, how that 10% was achieved? From what sources was that 10% performance achieved? It answers the question, how did the portfolio produce its performance and what are the expected sources of expected future performance, right? Then comes performance appraisal. It's concerned with identifying and measuring the investment skill, that was the observed portfolio performance was due to investment skill or luck. Let's say an investment manager outperformed the index. So the performance appraisal part is concerned with identifying that whether the manager outperformed the index due to his skills or due to pure luck. So that's performance appraisal. Let's first talk about Sharpe ratio. It's defined as portfolio's observed excess return divided by the risk of the portfolio. We can both calculate the ex ante return, ex ante Sharpe ratio and ex post Sharpe ratio. The ex ante Sharpe ratio is expected portfolio return minus the risk-free rate divided by the standard deviation of portfolio. Ex post Sharpe ratio is the realized portfolio return minus the realized risk-free rate divided by the standard deviation of the portfolio realized. Portfolio with a high Sharpe ratio has the best risk adjusted performance, because this is basically the excess return for 1 unit of risk assumed. So if the Sharpe ratio is greater, that means you are generating greater excess return for 1 unit of risk assumed. So a portfolio with a high Sharpe ratio has a best risk adjusted performance. For negative performance, Sharpe ratio will be misguiding. It will be less negative for riskier portfolios. So we cannot use Sharpe ratio to analyze the performance of a portfolio which is negative. Disadvantages: it uses total risk as a measure of risk where only systematic risk is priced. Since it's using sigma p, that means it's taking the total risk of the portfolio into consideration. The ratio itself is not informative. We can use this ratio only in comparative purpose. Now let's say the Sharpe ratio of a portfolio is 0.05 or 5%. So this 5% number in itself doesn't matter to us. What matters is if we are comparing three portfolios A, B and C, and we are given their Sharpe ratios, let's say 5%, 6%, 7%. In this case, this information is useful because we can choose portfolio C based on the Sharpe ratio. But the number itself doesn't matter. The ratio itself is not informative. We only use this ratio in comparative purposes. Trainer ratio. It's defined as portfolios observed or expected excess return divided by the beta of the portfolio. So similar to the Sharpe ratio, we can calculate ex ante and ex post trainer ratios. Portfolio with a high trainer ratio has best risk adjusted performance because you are generating greater excess return for 1 unit of beta. Beta is your sensitivity to the market portfolio. For negative performance, trainer ratio will also be misguiding. Trainer ratio does not work with negative beta assets. If your beta is negative, trainer ratio will not work for you. Now, what are the disadvantages of trainer ratio? Similar to Sharpe ratio, the ratio itself is not informative. We can only use this this ratio in comparative purposes. Now let's see the M2 risk adjusted performance. It's the measure of portfolio return that is adjusted for the total risk of the portfolio relative to that of some benchmark. We can calculate both ex ante and ex post M2 risk adjusted performance measures. It's equal to the Sharpe ratio times the market standard deviation plus the risk free rate. This is your risk adjusted performance. The Jensen's alpha is based on systematic risk. It's the difference between the actual portfolio return that you achieved and the calculated risk adjusted return, that is a measure of portfolio's performance relative to the market portfolio. That means the risk return that you actually generated minus the return that was expected to be generated. The difference between these two terms is called the Jensen's alpha. If the alpha is positive, then the portfolio has outperformed the market. If alpha is negative, the portfolio has underperformed the market. It's commonly used for evaluating institutional managers, pension funds and mutual funds. Values of alpha can be used to rank different managers and the performance of their portfolios, as well as the magnitude of underperformance or overperformance. So this is it for this module. I'll see you in the next video where we'll talk about the next topic, portfolio management. Thank you very much.